Imagine waking up one morning and discovering that the dollar in your pocket buys half of what it bought yesterday. Not because of inflation, not because of a recession, but because the rest of the world decided, quietly and all at once, to stop using it. This has never happened to the United States. But it has happened before, to another country, one that also believed its currency would rule the world forever. That country was Great Britain, and the day the world stopped trusting the British pound, the empire was finished. Today, Professor Ashford is going to walk you through what that day could look like for the American dollar. This is not a prediction. This is a scenario, built on real data, real trends, and real history. And by the end of this video, you will understand why the most powerful weapon America has ever built is not a missile or an aircraft carrier. It is a piece of green paper, and what happens if the world stops believing in it. Welcome back to Professor Ashford. This is where we follow the money behind the rise and fall of empires. And today, we are going to do something we have never done before on this channel. We are going to build a scenario, a researched, data-driven, step-by-step scenario of the most consequential economic event that could happen in the 21st century. The day the United States dollar loses its status as the world's reserve currency. But before we get to the scenario, we need to understand why the dollar is so powerful in the first place. Because most people do not realize just how extraordinary the dollar's position truly is. As of early 2025, the US dollar accounted for approximately 57% of all global foreign exchange reserves held by central banks around the world. It was used in roughly 89% of all foreign currency exchange transactions. It was the currency in which 96% of international trade in the Americas was invoiced, 74% in the Asia Pacific, and 79% in the rest of the world. Nearly half of all international debt was denominated in dollars. The vast majority of global commodity markets, from oil to wheat to copper, priced their goods in dollars. This means that every country on Earth, whether it likes America or hates it, needs dollars to participate in the global economy. To buy oil, you need dollars. To service your international debt, you need dollars. To hold reserves that protect your economy from shocks, you need dollars. This creates a constant, massive global demand for the American currency. And that demand is the foundation of American economic power. It allows the United States to borrow at lower interest rates than any other country because everyone wants to hold dollar-denominated assets. It allows America to run enormous trade deficits year after year because the world keeps sending goods to America in exchange for dollars that they then need for other transactions. And it gives the United States a weapon that no other country possesses, the ability to cut any nation, any bank, any individual off from the global financial system simply by denying them access to dollars. This is the power that backed the sanctions against Russia. This is the power that isolated Iran for decades. This is the power that makes the SWIFT financial messaging system, which processes trillions of dollars in transactions every day, an instrument of American foreign policy. The dollar is not just money. It is infrastructure. It is leverage. It is empire. Now, with that foundation in place, let us build the scenario. It does not begin with a single dramatic event. It begins with erosion. Slow, steady, almost invisible erosion that has already started. The first layer is sanctions. When the United States froze over $300 billion in Russian central bank reserves after the 2022 invasion of Ukraine, it sent a message to every country on Earth. Your dollar reserves are not really yours. If you cross America, your savings can be confiscated overnight. For Russia, this was devastating. But the unintended consequence was that every other country started asking the same question. If they did it to Russia, could they do it to us? Central banks around the world began quietly diversifying away from the dollar. The share of dollar reserves held globally dropped from over 65% in 2016 to around 57% by early 2025. That might sound like a small shift, but when you are talking about trillions of dollars in global reserves, even a few percentage points represent hundreds of billions of dollars moving out of American assets. The second layer is BRICS, the alliance of Brazil, Russia, India, China, and South Africa, which has now expanded to include Egypt, Ethiopia, Iran. The UAE and Indonesia represents roughly 48% of the world's population and about 39% of global GDP measured by purchasing power. These nations have been actively building alternatives to the dollar system. Russia and China now settle approximately 99% of their bilateral trade in rubles and yuan, completely bypassing the dollar. Brazil and China signed an agreement to trade in their own currencies. India has been purchasing Russian oil in rupees. China's cross-border interbank payment system, known as CIPS, now connects roughly 4,800 banks across 185 countries and is growing at over 65% annually. A blockchain-based payment platform called BRICS Pay is being developed to enable transactions between member nations without touching the Western financial system at all. And BRICS central banks have been buying gold at an unprecedented pace, adding nearly 800 metric tons in 2025 alone, pushing their combined gold reserves above 6,000 tons. Now, none of this has replaced the dollar yet. Not even close. The dollar is still dominant. But the infrastructure for an alternative is being built piece by piece, pipe by pipe, bank by bank. And that is what makes the scenario possible. The third layer is America's own actions. The tariff wars of 2025 and 2026 sent a signal to every trading partner on Earth that the United States was willing to use economic force against anyone, including its closest allies. Canada, Europe, Japan, South Korea, all of them were hit with tariffs that disrupted decades of integrated supply chains. The Supreme Court struck down the majority of those tariffs as illegal, creating constitutional chaos. And the Iran War of 2026 shut down the Strait of Hormuz, disrupting 20% of global oil supply and sending energy prices soaring worldwide. Each of these events individually is manageable, but together they create a cumulative loss of confidence in the stability, predictability, and trustworthiness of the American-led financial system. And confidence is the only thing that gives a reserve currency its power. So here's the scenario. Professor Ashford's scenario. Remember, this is not a prediction. This is an illustration of how the dominoes could fall, based on the trends that already exist. It begins with a trigger event. Perhaps it is a prolonged closure of the Strait of Hormuz that forces Asian buyers to settle oil purchases in yuan rather than dollars, simply because dollar transactions are too slow or too risky during the crisis. Perhaps it is a decision by Saudi Arabia to begin accepting yuan for a portion of its oil sales to China, a move that has been discussed for years. Perhaps it is a new round of American sanctions so aggressive that a critical mass of nations decides the risk of holding dollars outweighs the benefit. Whatever the trigger, the first domino falls when a major oil exporting nation begins pricing a significant share of its crude in a currency other than the dollar. Oil is the keystone of the dollar's global role. When Nixon detached the dollar from gold in 1971, it was the deal with Saudi Arabia to price all oil in dollars that kept the currency dominant. The so-called petrodollar agreement meant that every country that needed oil, which is every country, also needed dollars. If that link breaks, even partially, the structural demand for dollars begins to decline. The second domino falls when central banks accelerate their diversification. A survey by the World Gold Council in 2025 found that 73% of global central bankers believe the dollar's share of reserves will decrease over the next 5 years. If a trigger event validates that belief, the slow trickle of reserve diversification could become a flood. Central banks do not announce these moves. They execute them quietly over months and years, selling dollar assets and buying gold, yuan, euros, and other currencies. The third domino is the bond market. The United States government finances its enormous debt, which now exceeds 101% of GDP, by selling treasury bonds to investors and governments around the world. Foreign holders currently own trillions of dollars in U.S. treasuries. If confidence in the dollar weakens, demand for those bonds declines. When demand for bonds declines, interest rates rise. When interest rates rise on $36 trillion of national debt, the cost of servicing that debt explodes. Interest payments are already approaching $1 trillion per year. A sustained increase in rates could push that toward 1.5 or even 2 trillion, consuming an ever larger share of the federal budget and forcing painful choices between defense spending, social programs, and debt payments. The fourth domino is domestic. Higher interest rates mean higher mortgage rates, higher car loan rates, higher credit card rates. The cost of borrowing goes up for every American family and every American business. The stock market, which has been inflated by decades of cheap capital, faces a correction. Housing prices, which depend on affordable mortgages, come under pressure. The economy slows, tax revenues fall, and the deficit grows even larger, requiring even more borrowing at even higher rates. It becomes a cycle that feeds on itself. And the fifth domino, the one that truly marks the end of an era, is psychological. Once the world begins to believe that the dollar is declining, that belief becomes self-fulfilling. Investors move money out of dollar assets not because the dollar has already collapsed, but because they fear it might. Countries shift reserves not because the alternatives are better, but because holding too many dollars feels too risky. Traders sell dollar-denominated bonds, not because America has defaulted, but because they want to sell before everyone else does. The loss of confidence creates the very outcome that everyone feared. This is exactly what happened to the British pound. In 1945, the pound was the world's primary reserve currency. Britain had run enormous debts to finance 2 world wars. Its empire was overextended. Its economy was weakening. And slowly, then all at once, the world shifted to the dollar. It did not happen in a single day. It happened over about 2 decades. But once the trend became visible, it accelerated. By the 1970s, the pound had been devalued multiple times, and Britain was forced to accept an IMF bailout the final humiliation for what had once been the world's greatest economic power. The parallels between Britain then and America now are uncomfortable. Britain in 1945 had a national debt exceeding 200% of GDP. It was maintaining military commitments on every continent. It was running trade deficits it could not sustain. And its allies, particularly the United States, were quietly building the systems that would eventually replace British financial leadership. The transition did not require a conspiracy. It required only gravity. The weight of debt, overextension, and eroding confidence did the rest. Now, let Professor Ashford be absolutely clear about something. The dollar is not going to be replaced tomorrow. There is no currency on Earth that can match the dollar's liquidity, depth, and institutional backing right now. The yuan is controlled by a government that restricts capital flows. The euro is backed by an economic union that has its own structural problems. Gold cannot be used for digital transactions at scale. A BRICS currency does not exist yet, and the internal divisions within the alliance, particularly between India and China, make its creation enormously difficult. But the question is not whether the dollar will be replaced by a single rival currency. The question is whether the dollar's dominance will gradually erode as more and more transactions happen outside the dollar system, as more reserves are held in gold and alternative currencies, and as the infrastructure for a multipolar financial world slowly matures. And on this question, the trend is clear. The dollar's share of global reserves has fallen from 72% in 2000 to about 57% in 2025. That is a loss of 15 percentage points in 25 years. If that trend continues at the same pace, the dollar would fall below 50% of global reserves by the mid-2030s. And if the current combination of sanctions overuse, tariff wars, military overextension, and fiscal unsustainability accelerates the trend, it could happen faster. The United States is not powerless to prevent this. But preventing it requires something that no empire in history has proven very good at. It requires restraint in the use of sanctions, so that the dollar is seen as a neutral medium of exchange rather than a weapon. Restraint in fiscal policy, so that the national debt does not spiral to the point where investors lose confidence in America's ability to repay. Restraint in trade policy, so that allies remain invested in the dollar system rather than building alternatives. And restraint in military commitments, so that the cost of maintaining a global presence does not bankrupt the treasury. Every empire that lost its reserve currency status lost it for the same reason. Not because a rival was stronger, but because the empire itself made a series of choices that undermined the trust the currency depended on. Spain debased its currency to fund wars. The Dutch overextended their financial system through speculation. Britain borrowed beyond its means to maintain an empire it could no longer afford. And in each case, the transition was gradual, then sudden. The dollar is the most powerful currency ever created. It has survived world wars, financial crises, oil shocks, and the rise of new powers. It may survive everything that is happening right now, but survival is not guaranteed by history. It is guaranteed only by the choices that are made today. And right now, Professor Ashford is watching the same patterns that preceded every previous reserve currency collapse. Overextension abroad, fiscal imbalance at home, weaponization of the financial system, alienation of allies, and a rising bloc of nations building the infrastructure to go it alone. The day the world stops using the dollar may never come, but the day the world starts using it less has already arrived. And in the economics of empire, less is how it always begins. Thank you for watching. If this scenario made you think about the dollar differently, subscribe to Professor Ashford and turn on notifications so you never miss a class.